Welcome to another episode of Tech Guys Who Invest. We're so excited to have Pancham Gupta on the show. Pancham, welcome to the show.
Thank you, Adam and Kevin, for inviting me. Glad to be here. Another tech conversation. We can geek out.
Yeah.
Absolutely love it.
Oh,
Excellent.
we'll definitely geek out. We like to ask our guests questions about tech, so we'll do that towards the end. But first, we want to explore how you escaped a rat race. So if you can, tell us about that.
Sure. Like I can give you a little bit of my background first, and then I can talk about how I escaped the rat race. So I actually am originally from India. I came here for my master's and got my degree in computer science. And my idea was that, I will get the master's, work here for a couple of years, and then go back to India for good. And then after working here, I got married, and then we in 2009 we literally sold everything, every single piece of furniture, to move back. And then we found out that we were expecting a baby, and we were like, you know what, it's hard to move houses, forget countries, to while you're in that process of 9 months. And so we are like, okay, you know what, we'll wait for some time. And in 2011 we decided, 11 12, that we decided we're going to stay here. And that's when I stumbled upon this book. I started in thinking about investing in this country, and because I thought that I'm going to stay here forever. So I stumbled upon Rich Dad Poor Dad, Cashflow Quadrant, and that's where it all began. And started investing in single family homes, duplexes, triplexes. In next 4 or 5 years I expand into 5 different states and buy multiple properties, working with multiple property managers, some self-managed here locally. And slowly realized, I'm sure if you guys have done this, that this is not scalable. And I was working a full-time job then, and I was taking calls over the lunchtime, or after work, or sometimes even have to escape meetings to go and take these calls. And it was getting very cumbersome and difficult to scale up. And I was like, you know what, there has to be a better way. And that's when I started looking into syndications. In 2017 I made a decision, literally, that doesn't matter what happens, in 2019 I'm going to quit. And that's what I did. But in those 2 years I really made sure that we scale up our I partnered with one of my very long time friend, and we started syndication 2017. And 2019 I quit my job. So it was a long process. There was a long mindset struggle. It was not easy at all. I was working way too hard at that time, still working hard. But that, I had to get over mindset. I had to hire an external coach to actually have quit to help me quit my job. And you guys know tech pays really, really well.
Yes.
So it was hard.
Oh, man, that's awesome. I love it. There's so much in there. We can't wait to unpack. So why don't we start with the mindset thing? Because I think a lot of people are where you were. They want to one day leave that trading time for money and escape the rat race. What are some kind of internal barriers you had to push through, and how did you push through those?
Yeah, so that's a great question. And this is something that is, very difficult to overcome. And I'll tell you what I had to go through. So if you remember, I don't know if listeners have read this book, Cashflow Quadrant. If you haven't, I highly, highly, highly recommend that. So there is this ESBI quadrant in that, where employees, self-employed people, business people, and investors that we have in that quadrant. And Robert Kiyosaki mentions that for you to move from left quadrant to the right quadrant, where most of the wealth is controlled, you have to become a butterfly. The process is so difficult. It's like going from a caterpillar to becoming a butterfly. And that's exactly what I went through. So I, so I was so scared to quit. I had so much fear. At the end of the day, it was all fear of failure, if I really think about it. And the environment around me was not conducive. Again, like my family, my wife, everyone was like, you know what? who's going to what about the benefits that we are getting, what about this really high salary that you have, all this, like what if it doesn't work? And I was like, what if it does? And it was so bad that I actually hired a mindset coach. And when I had the very first call with that mindset coach, I told him that my goal to hire you is to help me quit. And when I went back to my wife, that, what, I'm actually hiring a coach to help me quit. She was like, to do what? To help me, to help you quit? Why are
Awesome.
you spending money on asking someone to help you quit? If you want to quit, just quit. I was like, yeah, I wish it was that easy, but it wasn't easy. And I was just getting in my own head, really, to get over that barrier. So yeah, you know what, like, I really made a decision. Like, it was not an easy decision. My income now is far less than what it was then, but I had this long term vision, which helped, my coach helped me create that, and I did not see full time job in it. Like, I was like, that job does not fit in my long term goal. So it has to be done at some point. When is that point? Salary is going to keep going up, right? Either I can wait for my income to far overshoot my salary, which was very high. So it was like, I just have to make a decision and just quit. So
Wow.
that's how.
Good for you. I for a number of different things, right? You looked at that fear and said, you know what, I'm going to do it anyway, which is a very difficult thing to do. And you went and saw a coach. And I think the coaches, for people who haven't seen a coach or mentor of any kind, it's hard to grasp the value until you've actually experienced it. And speaking of that mindset coach, how did you go about finding this particular coach?
So I actually, if I remember, I met him at a conference, and he was speaking at the conference, and really liked what he had to say. Scheduled a 45-minute free, like, introductory call. Uh, so really connected, and I was recommended, as well. Like, I got a bunch of references, and that's how I connected. I can talk about the name if you want here. Totally up to you guys. But yeah, that's what I did, and it worked out really well.
Sure. Yeah. I mean, at the risk of overloading them with business, we would love to throw a name out there if you're comfortable doing that. That's
Yeah,
no
sure. Like,
problem.
I hired the guy named Trevor McGregor. He is one of he coaches a lot of real estate investors, and so I got his help. And over the years, I really learned that we as engineers, like, we are very analytical, right?
To a
Very, very
fault.
analytical. Yeah, the seg fault kind of mentality. Oh, there's a code, like, there's a crash here, there's a memory trashing somewhere, it has to be a process, it has to follow that process in the debugger, like, the mind works that way. So but the truth is that in real life, that's not how it works, right? So my goal has been now all this time that it's really about compressing the time frames. We as engineers get into this analysis paralysis mindset, and we think, oh, you know what, this ego comes in the mind, like, I can figure this out. Yes, you can, but it may take you 10 years. But if you hire this help, and they can help you compress the time frame from 10 to 5 to 3 to 2 years, that is all you need. And since then, I wanted to write a book. I've hired a book coach. I wanted to start a podcast. I hired a podcasting. I actually got a course, not a coach, but I got a course on that. So I wanted to do. I had a business coach, a sales coach. So it's really, like, I've been sold into this thing that it's an investment as opposed to a cost, and that's how it's really helped me scale.
Yeah, so that is really great to hear. A lot of people, myself included, before my mindset started to change, saw it as an expense, a cost, right? Like, it's so expensive to pay someone. But how huge is that, what you mentioned about accelerating it? And the most valuable thing we have is time, right? So it accelerates the time it takes to get that done. So that's really neat to hear you say that. And I think a lot of people need to hear that and sort of shift how they think about having a performance coach or someone to help you to that next level. That's
R-
fantastic.
Right. If you really think about it, right? Like every single professional player has a coach. There is a
Right.
reason for that, right? And not only that's what we see in our real world, that all these players have coaches, but in reality, all the CEOs and all the people who are professional, they also have coaches, because you don't know what your blind spots are. And you want someone to be brutally honest to you and like call your BS and say that, you know what, you're wrong there, and you have to be open to learning and accepting that fact. And that's all. You have to be coachable. If you're coachable, yeah, the world
All
opens
right.
up to you.
This is good stuff. I'm loving it. So, Pancham, you run the goldcollarinvestor.com. Can you tell us what is a gold collar investor?
That is a name that I came up with. So you know what, tech guys, like I said, they're making, if you guys know, in the last decade or 2 decades, the salary levels have gone up exponentially, right? What probably the bankers were making, the tech guys are making now. And so I was thinking of a name that I really want to talk to people who are high paid professionals, people who make really high salaries. So we have blue collar workers, we have white collar workers. I was like, you know what, people who are getting really highly paid, what do we call them? They're gold collar workers. And that's why, you know what, I came up with the name gold collar investor, which is people who are making really high salaries. Tech guys included, bankers, lawyers, all these guys. And that's how, helping them invest money, diversify outside of Wall Street investments, not just real estate but other things. And I talk about personal finance, and that's what all gold collar investor all about.
I
Brilliant.
love it. I
Me
love
too.
it. So when you're talking about these high income earners, generally speaking, and most of the time, high income means high taxes. So how do you help those high income earners with investing in real estate?
Sure. So what just real estate, first of all, you need to get educated, right? Like that's the whole purpose of the podcast. You guys are doing great job by educating people about the benefits of real estate, right? To tech guys especially, again, we are very analytical, right? We don't worry about, we love what we do. And I used to love my job, don't get me wrong. Like I love coding. um uh, but what happens is that, because in our school system we're never taught of this thing, and when we get into this real world and start working, we absolutely love what we do. We don't pay attention to the things that the tax code wants us to do, right? So uh, what I'm doing as part of the podcast, or the investors, these tech people, is that really educating them on the benefits of investing in real estate. And then with that, tell them like what are these benefits and show them the path, and then making them invest in this. So there is an acronym that I read somewhere. I did not come up with it, but real estate is an ideal investment. I'm not sure if you guys heard of it. I can quickly go over that. IDEAL.
Please.
Uh,
Yeah, it'd be great.
yeah, so literally speaking, real estate is an ideal investment. I stands for income, D stands for depreciation, E stands for equity, A stands for appreciation, and L stands for leverage. So I break it down piece by piece, point by point, like why all of these things are there in real estate. So I income, which is really the cash flow, after you pay all your expenses and the rent coming in and the other income coming in, it's throwing off some cash flow for you. So that's the income part. D is the depreciation. That's the beauty of this entire thing. Even though I was making a lot of salary, but my effective tax rate every year was going lower and lower and lower because of depreciation. And that is really the uh, uh, paper loss that we get because of the tax benefits. We all heard recently in the news that Trump is paying only $750 in taxes. There's a reason for that. Again, I don't want to get political here, but the reason for that is that depreciation. A lot of these passive losses that you can get from investing in real estate. And then E stands for equity, which is the appreciation. The every year. the equity that you pay down when you're making your mortgage payments, you're building that equity, right, in the property year over year, and you're not paying for it. It's the tenants who are paying for that. And then A stands for appreciations. That's the cherry on the cake. Over time, real estate goes up, and if you have it in a great location, it will go up. And L really stands for leverage, which is, you can go out to a bank. The beauty of real estate is that, that you can go out to a bank and leverage it by putting down just 25%. Try going out to a bank and say that I want to buy Apple stock, even though it's an amazing company, and tell them to give you 75% leverage on that. You'll see what they say. And that's so that's the beauty of real estate. And all of these combined, when you package it together and do it really well, it can be an amazing investment and really truly wealth building vehicle.
That's fantastic. Love that acronym. If you don't mind, I'm going to borrow that indefinitely. um,
Absolutely.
so, Pancham, a lot of people who are just beginning to educate themselves about investing, considering options, they don't necessarily want to get into the business like you, me, and Kevin are, because it's a lot of work, right? Despite what some of the people selling trainings and courses would tell you, this is a lot of work. So they're trying to think, well, if I passively invest alongside a more experienced investor, do I still get those ideal benefits?
That's a great question. And my entire podcast is on that, because the reason I quit, even though I love my job, I absolutely got passionate about this stuff and really helping people who are making high salaries to help them invest passively. So, yeah, you're all of these benefits that we are talking about ideal, they all the passive investors can avail that if they're investing alongside experienced sponsors. All these big deals get done by the process of syndication. And all the benefits that we are talking about, you get benefit of that because you're part owner. Yes, you're limited partners, but you're part owners, you're partners. That's why you get all those benefits. And yes, you do not have, there is this, you're trading really the control for diversification, right? There are only three things that you have to worry about whenever you're investing. Like, people really think in their head, I was thinking that way, and a lot of our investors, I get this question a lot, that should I be investing actively? Should I find a single family home or a duplex or a triplex near my place, and should I invest there, or should I invest in your deal or someone else's deal? uh, the answer to that is that it's really, you have to ask yourself what you want out of these three parameters, which is control, time, and risk. Right? How much control do you want? How much time you want to commit to it? And how much risk you want to take. So if you answer that question for yourself, you can really find out on what spectrum you fit in, like whether you want to be active or whether you want to be passive. I can tell you, a lot of our investors, they'll absolutely love doing what they do, which is tech, geek out on techs, new technology. They don't want to worry about any of this, dealing with tenants or the property managers. For them, I think passive investments is the way to go,
Yeah.
right? So that's, I don't know if I answered your question. Yeah, you do
Yeah.
get all the benefits.
That's fantastic. I love that you said you
Mhm.
broke it down as to what you should think about when it comes to deciding whether or not you want to be active or passive. Because I think there are a lot of people that are on the fence that don't realize that you can achieve certain benefits by being a passive investor. So thank you for breaking that down. Now I want to transition more to when you're analyzing a market, you and your team thinking about acquiring a property or properties in that area. What do you look for? And I'm not looking for your secret recipe, but just kind of a general idea. What points do you say, oh, this makes it a good market, this makes it a bad market, etc.?
No, so there is no secret recipe here. I can share exactly what we do. It's just like coding, right? Everyone can learn coding and they can, write code, but there are so many ways to achieve the same thing. You can have n squared algorithm, O n squared. Oh, I don't want to geek out. I don't know, versus log n versus whatever, and so I would say that, the what we look at many different things when it comes to deciding a market, right? We look at overall job growth. We have like checklist of about 15 to 20 items. We look at this data. So overall job growth, demographics, population growth in that area, job diversity. What that means is that no one sector can dominate that particular market. For example, Detroit, it was all made up of car, automotive sector. If that goes down, the entire city can become unemployed, right? So we look at like no one sector can dominate more than 18 to 20% of that market. Then we look at where are the millennials moving to, right? You can look at that by looking at stats from U-Haul or United Van Lines or the airlines. You can see how many one-way rentals are being done, or over the last 1 year, where there was only like one way rental and what was the destination, and you can pick the cities where you can see the stats. You can do with that, you can look at where are the airlines adding more segments, and so that will tell you, that's an indicator. So all of this data is available. You can go and check that out. And then um, we see where are the builders building, right? Where's the development going on, right? They see something, sometimes these big companies see something which we can't see, so we follow that, right? And then within the sub market, we look at a lot of other things. I can talk about that too, but the idea is really that once you have all of these narrowed down and you pick a market, you are trying to limit your downside risk. What that means is that when the market tanks, right, these will be the last one to get impacted, but the first ones to come out of it, right? That's how we pick our market. And then within that market, we have other things that we look at. I can talk about that if you guys want.
That's great, Pancham. Let's talk about leveraging relationships in the industry. What relationships should investors focus on?
So when you say investors, you mean passive or active?
Oh yeah, that's a good question. I think we're thinking of active investors, but I think I'd like to know what passive investors should focus on also.
Yeah, a
Okay,
little
I
bit of
can talk
both.
about, yeah, let's do both, right? Because
Okay.
it's very different. Even though it could be there's an overlap somewhere, but the 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 h- the importance is different, the categories are
Right.
different. So for the active investors, right, the relationship, like we said, first look at the market. Let's say you hone in the market, right? So then you are making relationships within that market with the brokers, with the property management companies, and also the lenders. If you're in that market, you live in there, you're looking at credit unions or the local banks, making relationships with them. And also, if you're looking into doing bigger commercial properties, then the commercial lenders. So these are the people who are you building relationships with. In the sector that where we invest in, which is multifamily, top 5 brokers to 10 brokers control 90% of the market. So for us, whenever we pick a market, we go and start building relationships with those brokers and trying to get on their list. And we do that. Then on the passive investment side, what you really need to look at is the people you're investing with. You are not banking on the horse, but the jockey, right? The guy who's running the deal. We all know in tech, like, if you've managed people, good team can make a bad project good, but a bad team can take a good project and bring it,
Run it into
burn
the
it down.
ground.
Right. So yeah, so the number one thing is like knowing the sponsor, who's the person running the deal, and how comfortable you are with their investment criteria and in general track record, and do you know, like, and trust that team. That's number one. Number two is that you also need to know your goals. What kind of money, so what kind of sector you want to invest your money in. So for example, I have investors who really think that they want to be very environmental friendly, right? They don't want to invest money into, let's say, oil and gas fracking. Like, again, it's very individual, but goals for them, you can then pick a you have to know where you want your money invested. We have investors who really love multifamily because we're providing housing for affordable affordable housing for low income people. They want their dollars to go there. So that part is something that they want to themselves figure out for themselves, and then start learning about the teams who are investing in these areas, and then learn about the markets too a little bit.
Great.
Great advice, not from both the active and passive side, and you tied it into that market understanding, and really it amounts to you knowing your investor identity, whether it's that particular area, if you like the southeast, northeast, whatever part of the region. Those are all good points. And to dive a little bit more technically into multifamily here, on your website, and when you talk about the process, you mentioned your team focuses on increasing the net operating income of a property after acquiring it. Can you break down what net operating income is and why increasing it is important?
Absolutely. So net operating income is like the name suggests, you have some income on the income coming in, the rent coming in, or some other expenses on the property. Let's say they're paying you for some utilities, or they're paying you for application fee, all that. So that's the income that comes in. And then you have some expenses. For example, you have people on your payroll, or a property management company, you're paying for utilities and all that stuff. You have some expenses. So at the end of the year, if you take all the income that you have and all the expenses that you have, and you subtract them out, the whatever is left is called net operating income. This does not include your mortgage payment, by the way. This does not include your uh, anything that has to do specifically to you, because I can go out and get a 2% loan, and you can go out and take a 5% loan, because of your credit profile. That would be different. But when you're analyzing a property, that net operating income is really purely property related income and expenses. And once you have that NOI, your goal at the end of the day is to increase that NOI. And why is that? This is mainly for commercial properties. In a single family home, or a duplex, or a triplex, what happens is the value of that home is determined by the comps in the area, right? Doesn't matter that property is producing $10,000 every month in cash flow because you're doing Airbnb, but the house next door, it's if it is $50,000, your house is going to be $50,000. Doesn't matter, you put gold in it, right? So so that's how that gets the price gets determined for the non-commercial properties. But if you go into commercial, which is any time four or more units, sorry, five or more units, there the value of the property is determined by how much income that property is making. So if the property NOI goes up, the value of the property goes up. So and that's exactly what we do, which is like we buy properties, these 100 plus multifamily units in the southeast apartment buildings, and we try to increase the NOI by adding value to it, and which is called forced appreciation. And once you do that, the value of the property goes up, and then we either sell it, or we would cash out refinance that property.
And the beautiful thing about that is it doesn't take a lot of rent increases to really push that NOI way up. It's such a lever, you know.
Yeah, exactly. If you really do a simple math, like let's say you increase the rent by $50, for the ease of calculation, and let's say you have 100-unit property, that's $5,000 a month, and that's $60,000 a year. And if it is trading at 10 cap, just multiply by 20, that is 60,000 times 20. That's how much you increase the value of that property by
For
1.2 million.
$50 a month. And that right there is why multifamily investors get wealthy. All right. So you mentioned selling at the end. Let's talk a little bit about some typical exits for multifamily investors. And if you don't mind, just kind of touching on what that experience is like for the passive investors too, like sort of what happens to them usually and what they typically do after that?
Sure. So there are mainly two exits at a very broad level in a in real estate in general, commercial real estate. One, especially if you're invested passively in a syndication. One is you sell the property, you go through your business plan, you add the value, increase the NOI, and then you just sell it, right? And when you sell it, you get your money back, and you also get all the appreciation that happened on the property, that comes back to you, right, as an investor. And that's it. It's like you sold the stock, right? What happens after you sell the stock? Money comes in, and that's it, right? And then you will get a K1 towards the end of the year, to file for your taxes, which you're getting every year anyway. And the second exit is really cash out refinance. What that means is that you invested in a property, you executed your business plan, you increase the NOI. Now the value has gone up so much that you are able to go to a bank and say, hey, see, my NOI has gone up so much, I want to refinance this property. And they will look at the NOI, they will get the appraisal done, and then now they will give you 75%, let's say, of the loan amount of the new appraised value. And you take that loan, you pay off your old loan, any of the other refinance expenses, and whatever is left is the money in the bank. And now you take that money, you give it back to the investors. And in some cases, if you it's a slam dunk deal, you will be able to return 100% or more of the capital to all of your investors, and they will still be in the deal, they will still make the cash flow. We call that infinite return model, which is, it's you playing with the you basically have nothing in the deal, and you're still making money off your of your equity ownership in the building. So that's if that's when you throw it out of the park. And in typical scenario, you can do 50, 60, 70% of return of capital. And that would be the second kind of exit. It's not really an exit, but a capital event, that's what we call it.
Right. Yeah. Hey, just a quick, just to kind of add on to that, when investors love that because just to be sure everyone understands what happens there, if that refi event happens, investors get most or all of their money back, but there's still a few more years in the deal. They're still they're still cash flowing. They're still getting the profits there. When the deal sells, they get the profits, and they have already been able to kind of redeploy that money they got back somewhere else.
And the beauty of this capital event is that they don't pay any dime in taxes, because you just it's a loan proceeds, so it's a debt. Yeah.
That's
Nice.
awesome. Well, Pancham, I gave you a warning that we're going to talk tech now. We wanted to geek out with you. So when we talk about one of the questions we like to ask our guests is about technology. So I wanted to ask you, what is your favorite piece of technology to geek out on? Is it software? Is it AI? What is it that you like to just sit there and consume information about?
So, for me, for a very long time, I was looking at this new technology. I was running a data platform at a fintech company. And, I would geek out on all these different data technologies that were coming up, like Spark. It started with Cassandra and, these Apache open source technologies. Cassandra, which is a persistent data store, and then the Spark, all these technologies around data platform. And then, but in general, now that I'm not working full time and purely in tech, AI really fascinates me a lot, right? The artificial intelligence, and I love to read about that. And that's what I kind of geek out on a little bit when I'm reading news articles and all that.
That's cool. Hey, Pancham, I am just curious what type of programming you did when you were doing it professionally. Were you like a front end developer, a back end guy? What kind of languages you used? I'm just curious.
Sure. So my majority of my career, I did C++,
Okay.
and I was a backend. I worked for Bloomberg, the company, and I was doing mainly backend programming, but also I did some front end. but majority of my time was really building the backend systems in the derivatives financial world, building financial systems
Wow.
in the data platform. Yeah.
Awesome.
Oh yeah, just simple math.
Right.
That's funny. Pancham, you know what? Thank you so much for being a guest on the Tech Guys Who Invest podcast. If people want to find out more about you, if they wanted to learn how to become a gold collar investor, where can they find you?
Sure, they can email me at p@thegoldcollarinvestor.com, or if they want to know my top 6 reasons to diversify outside of Wall Street, I do have a free report which they can find on the website thegoldcollarinvestor.com/download.
Awesome. And they can find your podcast on the goldcollarinvestor.com too, right, Pancham?
Yeah, absolutely. We talk all about personal finance, not just real estate, but also other tax saving strategies and asset protection and estate planning, all of that good stuff.
Awesome.
Awesome. Thank you so much, Pancham, for being a guest again.
Oh, thank you. Absolutely. A lot of pleasure to talk to tech guys and geek out.
Yeah, thanks.
All right, man.